In this video, I'm going to talk about how I build a six-figure stock portfolio at the age of 22, which continues to grow and compound now that I'm 26. Specifically, I'm going to talk about three main things: income, expenses, and investment strategy, which all help to build this portfolio. Let's jump into number one, which is income. I got my first job at Macca's when I was 17, basically making slave money for about a year. Then my next job was at 18, working at NAB, one of Australia's big four banks. This move, which took a lot of rejections by the way, it wasn't easy, changed the trajectory of my career into my chosen field very early on. I was working full-time initially, then changed to part-time while doing uni, and this allowed me to build up experience in the industry and get into the stock market very early on. When I graduated, I already had 2 years of banking experience under my belt, and every single job promotion, every single job offer after that has led to a pay bump. But in each job, the focus was doing the best that I could, learning everything very quickly, and then progressing on to the next role, taking on a new challenge, and getting to that six-figure salary that every person working in corporate dreams about. Now, if I hadn't done this and stuck with the old mindset of staying in the same role for a couple of years, I wouldn't be in the position of getting to that six-figure salary very early on. And then consequently, there is no way I would have been able to build my portfolio very quickly. So if you're working a job right now, ask yourself, what are some things you can do right now to give yourself an unfair advantage over others? What are some things you can do? What are some courses you can do, qualifications to upskill yourself, or even a job title to give yourself a slight edge and move on to the next role? Remember, if you just follow what most people are doing, you're going to get the results of most people, which is just average. But if you're watching this video, chances are that you want more than that, and therefore you're going to have to do things that you haven't done before, and that's okay. For me personally, as I was getting these promotions and getting the pay rises, any additional money that I wasn't investing into the stock market was going straight into my high interest savings account, getting the best bang for its buck at the time. Now, given that the interest rate environment at the time was quite low compared to where we are today, still the money was doing the best that it could for that time. I also left some spare money aside for side hustles like the social media channel and YouTube and things like that, which helped here and there. So if you're watching this video and for some reason you're not able to upskill in your current role or get a promotion because for some reason you are stuck, there are still some things that you can do. You got to ask yourself, is there an opportunity for you to start a side hustle in your spare time? Is there an opportunity for you to get a part-time or casual role to fill up the extra hours? Income is by far the biggest thing that you need to build a strong portfolio. It is basically the lifeblood of your portfolio, and your portfolio needs regular fuel to keep on going, for it to keep on compounding. So I would really focus on trying to get your income up very quickly. And as long as you're continually working on increasing your income and you're not stagnating, you're on the right path. But of course, all of that doesn't mean much if you haven't really got a handle on what's going out the door, which is the expenses side of things. So jumping into expenses, ever since I got my first job, my foundation has always been keeping my costs low. I've naturally been a very frugal person, and so much so to the point where it's gotten to be detrimental at some points, and I've reversed some of the habits as I've started to build up my net worth. But still, being frugal is a very good foundation. But if you're just starting out, you have to get the basics right. Personally, I've never really properly budgeted because I know that my baseline expenses are going to be pretty low, and there's no point trying to scrutinize little expenses because it's not going to lead anywhere. The only levers that I can pull is really increasing my income. But if you're just starting out, budgeting is a really good way to go. You can start off by money tracking apps like WeMoney, or most banks also have budgeting tools now. Or if you want to go old school, you can print out the last 3 to 6 months of bank statements, get a highlighter and start highlighting, start color coding, and really find out where the hell your money is going. Do whatever you need to do to track your expenses. You just got to get it over and done with. Now, by far the biggest expense for most people is their rent or mortgage, and for me personally, I am really privileged in that aspect, in the sense that I am living with my parents. Full transparency, of course. This is by far the biggest hack, especially if you're living in Sydney where everything is so expensive, and if you have the option to do it, it is not the worst thing you can do. Now, I'm not saying you have to live with your parents into your 30s, but even just a couple of years in your early adult years can really help to accelerate your financial plan. It can allow you to do more riskier things as well, and just have that peace of mind knowing that you have that safety net. Whether you're trying to start a business, start investing, or you're in between jobs, it's going to give you that peace. Now, if you're watching this channel, you probably aren't going to be like most 20-year-olds and going to spend all your money on expensive vacations or financing really expensive cars. So even just a few years, especially in your early adulthood years, is going to do wonders for you financially. The average age of moving out is increasing, so don't feel bad about it. Yes, you're not going to get the real world experience that other people are getting just because they've moved out, but that's just life. Every single decision that you make has a trade-off. choose yours. I'd much rather be in a financially strong position and move out a bit later and then be an adult, which I've got my whole life to be. When you're trying to chase financial independence, you've really got to take into account which advice you're taking in, including mine. Think about what I've said, if it resonates with you or not, because it's really important. Traditionally, if you look at society, they're going to tell you that living with your parents into your late 20s or even 30s is very sad. It's a very wrong thing to do. But that same society will then be living paycheck to paycheck, drowning in debt, barely any savings, and then they have the audacity to tell you what you should be doing with your life. It's completely up to you, but just understand that your rent or your mortgage expense is going to be the biggest expense that you'll be paying for your life, so make your decision wisely. In my opinion, as long as you're contributing to your parents financially, it is a whole lot better than paying rent to some landlord and then being broke afterwards. If you're someone that absolutely needs to move out, that's completely fine, but you still have a choice as to where you want to live. You can choose to live a bit further out and save tens of thousands of dollars in rent. You can choose to have a roommate. You can choose to live with a partner. You can choose to do certain things so your money goes further. The choice is yours. So when I had the first two things sorted out, I shifted my attention to number 3, which is investment strategy. When I first started out, I was doing a whole lot of dumb stuff like day trading and treating the stock market like a slot machine. This costed me so much gains where I would have made more if I just bought and held. If you're in this boat and you're day trading, you need to stop immediately. Trust me, it's not going to end well for at least 98% of you. We're talking statistically, financially, emotionally, even physically. I hope not. The point is, for the average person, it is a useless strategy. It is not sustainable over the long term, and your goal is to build wealth over the long term. It is not to get rich overnight. What you need to focus on is ETFs and index funds. Focus on consistent investing, no matter what the market is doing. Focus on a plan so your emotions are taken out of it. Focus on a predetermined strategy. Seriously, you got the income side sorted out, you got the expenses under control, but all of that is no use if your money is just squandered away buying some mining stock of a company that is going to go bankrupt very soon. Now, I get that right now there is a lot of noise about Trump and tariffs and a lot of uncertainty, and I completely get it. But you've got to understand that regardless of what you think of Trump, he is not going to be around forever. The next administration can completely overturn whatever Trump has done, and confidence can be restored in the market yet again. You really don't know what's going to happen, so you've got to take an extended view of the market. If you're a long-term investor, you shouldn't be looking at it with all doom and gloom. When in doubt, zoom out. Now, it's funny because I follow a lot of investing groups on Reddit, and I like to follow what's happening and what the sentiment is in these forums and things like that. And it's crazy to me how quickly people's tone has shifted just in the last couple of weeks. You've got people on Reddit, there's a guy that posted something on there talking about how he is considering removing his super from the US entirely just because of the current climate, and that to me is absolutely mental. Only just a couple months ago, the sentiment was the US is the best, market's gonna go up, and then in just a couple weeks, things are changing so rapidly where people are trying to effectively almost gamble or time their retirement savings on something that's happened in just a couple of weeks. It's really funny to me how the stock market is the only place in the entire world where people run away when there is a sale. So all of this to say, don't time the market, don't look at the headlines, stick to a predetermined strategy, invest, and keep on going. Now, if you look at most personal finance advice, there will be some rules of thumbs that people like to say, some general things such as the 50, 30, and 20 rule. 50% of your income should go towards your needs, 30% to your wants, and then 20% to savings/investment. Now, while this is good for most people that are new to money management and new to budgeting and things like that, and this is a good starting point if you're just getting into it, it's not really going to move the needle for you financially if your goal is financial independence, especially if your income is only, say, 100K, and if you're not a high income earner. You need to be more aggressive in the markets and allocate a much bigger percentage of your take-home pay towards investments and savings. And this is exactly what I did. My investing percentage of my take-home pay was over 50% when I finally started to get serious about investing, which turned out to be an average of 2K per fortnight into a set ETF. For context, my most consistent period of investing was during the 2022 bloodbath, and each time I invested, it felt like I was lighting my money on fire, but it was all worth it because the market rebounded shortly afterwards. I stuck to my strategy and kept going despite what the market was doing, despite all the negative news. If you stick to optimizing these 3 things, I promise you, you're gonna be much further ahead than you ever thought you would get. If you found value in this video, subscribe, and I'll see you guys in the next one. Bye now.